If you want to learn how to invest and trade with technical analysis in 2019, then stick around because in this video, I'll show you exactly what to focus on as a beginner in technical analysis for 2019 and beyond. Don't forget, if you want to continue to build your foundation in investing and trading as a beginner, make sure you subscribe to the channel and click on that bell icon so you don't miss a thing. Hi, my name is Linus and I am here to help you build your foundation for investing and trading success. Today, we are going to talk about technical analysis for beginners for 2019 and beyond, and we'll get started right now. The first thing we need to know are the principles and assumptions of technical analysis. There are three main principles and assumptions in technical analysis. The first is that the market discounts everything. What this means is that the action of the market reflects everything there is to know about the price, that everything is factored in when a price is taken into account. This is important because the main concept behind technical analysis is that just by studying market action, we can get a good idea of future price movements. This might seem to be oversimplifying the situation, but consider that all this really means is that supply and demand is demonstrated in market action. Classical economics teaches us that supply and demand set the price. If demand exceeds supply, then in time the price will rise, also known as a bullish market. When supply outstrips demand, this will lead to a fall in price or a bearish market. What causes supply to increase or reduce need not concern technical analysis. The result is all that matters. Technical analysis focuses on the price and the market, which is the result. Secondly, the market exhibits trends in the study of technical analysis. By tapping into what the market action tells us from the stock price, we are letting the market tell us in which direction it wants to go, rather than us trying to second guess the buyers and sellers. This is because prices tend to move in trends, so if the price is rising, it will in all likelihood continue to rise. The same applies when prices are falling or moving sideways. Of course, none of these things goes on forever, but it is generally expected that a trend will go on for a while before changing. When trading with the trend, your task reduces to identifying the trend as soon as possible so that you can enter the trade early and staying with it until it shows signs of reversing. Lastly, technical analysis believes that history repeats itself. Patterns and actions that have happened in the past tend to lead to the same results when they happen in the future. This is because prices are affected by the supply and demand in the market, and it is the people that drive the supply and demand. The psychology and behavior of traders and investors have not changed over decades, and this fact can be used to our advantage in technical analysis. Now that we know the main principles that constitute a technical analysis, let's take a look at the tools that we can use in technical analysis. We've talked about trends earlier, and one of the tools that many technical analysts use to determine the trend in the market are moving averages. A moving average moves out short-term price fluctuations and is based on past prices. For example, a simple 20-day moving average calculates the past 20 days prices and smooths out the price fluctuation by calculating the average and plotting it on the price chart. We can then use the moving average to identify price movement and determine the trend. The market has three trends: uptrend, downtrend, and consolidation. Uptrend is when prices rise, downtrend is when prices fall, consolidation is when prices move sideways. We can determine the trend using moving averages. Generally, when a shorter term moving average is above a longer term moving average, prices are in an uptrend. For example, if you use the 8 and 20-day moving average, when the 8-day moving average is above the 20-day moving average, prices are on an uptrend. If the 20-day moving average is above the 8-day moving average, or the longer term moving average is above the shorter term moving average, prices are on a downtrend. Moving averages don't tend to do well when the trend is sideways or in a consolidation. So in this video, I shared with you an overview of the principles behind technical analysis and the main technical analysis tool that technical analysts use to determine the trends and make profits from. There are many other tools and indicators in technical analysis that I didn't manage to cover in this short video, but the tool that I shared with you in this video, the moving average, is a powerful tool that can help you in your investing and trading journey, especially if you're just starting out. Let me know in the comments what other technical analysis tools and indicators that you want me to cover in my videos. If you want more investing and trading videos like this, check out the playlist on the right. I think you'll enjoy it. Continue to do better 1% each day, and I'll see you there.